Financials, a very important part of investing. In this second video of my series for investing for beginners, we will be talking about financials, specifically what to look for, how to read financial statements, and specific metrics to know in order to have confidence that the company you want to invest in is financially solid, or even better, financially thriving. So in my last video, I showed you this, my quality checklist. I use this to pick my stocks, and a company must check all boxes. Sometimes I allow exceptions, but it is rare. So today's video is all about the first checklist item, and we will want to look at a balance sheet, income statement, cash flows, and so much more. So stay tuned, we're gonna cover a lot. So let me start with this. They say you are who you surround yourself with. Would you rather surround yourself with friends that are financially irresponsible, so living beyond their means, taking out more debt than they can pay back, spending money on frivolous items, and never giving any thought to their financial future, or friends that are financially responsible, living within their means, friends that invest and save, that have low debt profiles, and are responsibly spending their money on more needs than wants? Well, obviously, you should surround yourself with financially responsible friends, as they will encourage you to do the same. It is empowering to be around others that have similar goals that will push you to do better, as you truly will give into the habits of others if you spend a lot of time with them. That is not to say that your financially irresponsible friends are not good friends, but if they have bad financial habits, that will only pressure you to do the same. Well, this is the same concept for investing. You want to invest your dollars into companies that are financially responsible, have a low debt profile, maintains low expenses, has good income revenue, invests its cash flows wisely, etc. Why would you want to invest in financially irresponsible companies? That will only limit and hurt your future gains. So we want to make sure our portfolios are full of companies that have solid and thriving financials, as it will lift your gains like a rising tide, and during hard economic times will provide safety and stability, as these companies will be able to weather those storms compared to companies that can't and end up going out of business, cutting their dividends, and more that destroys your wealth. So let's start by looking at a balance sheet. We are going to use Microsoft as the good example and 3M as the bad example. Hint, I own these two companies in my portfolio, and I don't like 3M. So now to find a company's financials. How do you do that? Well, you just need to search it. Every publicly traded company should have an investor relations site that you can look at all their earnings data. I simply will Google the company's name followed by the word earnings. So we will search Microsoft earnings. Scroll down and you will see the link. So go ahead, we're gonna click on that, and then you can scroll down, and usually they will display highlights or what they release to the press, but I like to always download something that's called the 10Q, which includes much more data. So we see the 10Q on the right. I will click on that and open it up. In this case, it's a Word document. How very Microsoft of Microsoft. All other companies are usually PDFs. And then you can start scrolling down, and we will see they first show their income statement. Okay, so now that I've shown you where to get financial information, we are going to look at their balance sheet, and I will give you some things to always look for. So a balance sheet will house assets, liabilities, and stockholders' equity. Assets and liabilities are pretty self-explanatory, so let's talk about stockholders' equity, sometimes also referred to as shareholder equity. It's the same thing. So stockholders' equity refers to the assets remaining in a business once all liabilities have been settled. This figure is calculated by subtracting total liabilities from total assets. So I think you've commonly heard this. The balance sheet has a simple equation, and that is assets equals liabilities plus stockholders' equity. A balance sheet needs to balance, easy to remember. So now back to shareholder equity. It's a company's net worth, or the total dollar amount that would be returned to its shareholders if the company is liquidated after all its debts have been paid off. So that's another way to think of this. This metric is frequently used by analysts and investors to determine a company's general financial health. If equity is positive, the company has enough assets to cover its liabilities. A negative stockholders' equity may indicate an impending bankruptcy. So you want to see positive stockholders' equity. Okay, the next thing I look for is that the total assets are more than the total liabilities. We obviously do not want a company that holds more liabilities than they have assets. This one is a simple, quick look. The third main thing I look at is their debt. specifically their long-term debt, as this is the hardest thing for a company to pay off. So with a lot of these metrics, you want to compare to their last earnings, which is usually displayed right next to the current quarterly earnings. You will see here Microsoft is displaying the September 30th earnings, and next to it are the prior June 30th earnings. So we want to see if their long-term debt is going up or down, and of course we want to see it going down, and it is for Microsoft. Do the same year-over-year comparison for the total assets and liabilities as well. We want to see assets increasing and liabilities decreasing. And Microsoft is moving in the right direction here with assets, but we do see liabilities increasing, and that looks to be the cause of some new short-term debt. So I'm glad we see this, as sometimes just because a metric is moving in the wrong direction does not mean it's a bad thing. In this 10Q, I found a few items that explain this debt. It first mentioned it does mature, this debt matures within 7 to 190 days, so it really is some very short-term debt. It also says we issue debt to take advantage of favorable pricing and liquidity in the debt markets, reflecting our credit rating. The proceeds of these issuances were or will be used for general corporate purposes, which may include, among other things, funding for working capital, capital expenditures, repurchase of capital stock, acquisitions, and repayment of existing debt. So they're telling you what they're kind of doing with this money. So what I will be looking for is this reducing over the next 3 earnings, since it is such short-term debt. Now, knowing Microsoft, this is debt they can easily pay back due to their massive cash flows, which I will show you soon. If their long-term debt was increasing instead of their short-term, that's when I would take a closer look, but short-term debt of this amount for Microsoft is not a big deal. So this is why you want to research items that are moving in the wrong direction to see if it is something bad or something that is okay, as the company is probably using it for their benefit and it will create a strong return in the future. Now, companies usually take out debt to use that money to fund some part of their business, like a new venture, for an acquisition, etc. If long-term debt increased significantly, you will want to research why they took out this added debt and see what it is going towards. Then you will have to decide if you think that is towards something that will create a benefit for the company and strong returns in the future or not. Microsoft, in another part of their 10Q, says they also use debt as a hedge against foreign currency risk and interest risk. So overall, I am comfortable with the short-term spike in their short-term debt. Lastly, for any of the data I will be covering today, it is always beneficial to look at the history of these numbers over the past several quarters to several years to see if they are moving in the right direction long term. So these are called trends, because sometimes 1 or 2 quarters don't tell the full picture, and no company will have a perfect quarter every quarter where all the metrics are moving in the right direction. So for example, if we look at Microsoft's long-term debt and shareholders' equity over the last 8 quarters, it looks great. Shareholder equity is increasing and long-term debt is decreasing. If we take it out to a yearly view, we see 8 years of trends and see that stockholders' equity has increased massively, and long-term debt, other than a short increase from 2016 to 2017, has gone down every year since. So be sure to look at historical data as well like this for all the data we discussed today. So Microsoft is the poster child for near perfect financials. You won't find many companies like this. So again, the balance sheet overall looks fantastic. To show you a bad balance sheet, let's look at 3M. I know this may be small and I apologize, but we will see assets are increasing, but so are liabilities, and at a much faster rate than assets. Long-term debt actually went down, but look at that equity. It's decreasing fast. Not a great sign for shareholders. Now, if we look at 3M's long-term charts, we will look at the annual first. We see that stockholder equity has been a little rocky, going up, and now flat. Long-term debt increased 6 years in a row and then started downtrending. What I want you to notice is that the long-term debt was higher than stockholder equity for many years. Not a good thing. Now, if we bring it into a quarterly view, a more recent detailed look, we see a negative trend starting to occur again. 3M once again has more long-term debt than stockholders' equity, and we are seeing that stockholders' equity has plummeted over the last 3 quarters. Not good. So this is why you must not only look at the balance sheet, but look at the history of the company. It tells a lot. Microsoft thrives while 3M continuously falls into the same bad metrics. I bet we see long-term debt start to go back up soon. Okay, so this is the balance sheet, And the main things to look for, there will always be a million ways to look at financials with all the different line items, but I want to cover what I feel is the most important to know. And as you grow as an investor, you can continue educating yourself. Now let's look at an income statement of Microsoft. So the first thing you want to look at is their revenue growing. We can see here, yes, it is. Revenue is the money generated from a company's products and services. Then we want to look at the total cost of revenue, which is the total cost incurred to produce and sell those products and services. Naturally, with inflation, this number will go up, but we want it to increase at a slower pace than the revenue, and it is for Microsoft. If the total cost of revenue goes down, that may be a good sign of efficiency improvements. Then we want to look at other expenses like research and development, sales and marketing, administrative costs, and things of that nature. This shows us how they are managing their expenses. Overall, slight increases for Microsoft. Then, of course, we want to look at the net income, which is taking all of the revenue against the expenses. We will see Microsoft's net income is increasing, a great thing to see. We also get earnings per share data. Now, earnings per share is basically how much money a company makes for each share of its stock. We want to see this increase, and it is. Okay, this is the income statement. So let's look now quickly at 3M's income statement, and we will see it's not a good income statement. Net sales are decreasing when comparing year over year for the 3 months ended and the 9 months ended. Total operating expenses are increasing massively year over year, and they went from being profitable, aka net income, to now making net losses. This is why it is important to look at financials. Of course, just like the balance sheet, you want to look at the prior history to see the trends for the income statement as well. All right, now on to the cash flow statement with Microsoft. Now, a cash flow statement makes up 3 main parts: cash flow from operations, so it's operating activities; cash flow from financing, so it's financing activities; and cash flow from investing, so it's investing activities. So basically, it is all the cash inflows and outflows. I mainly like to focus on the cash flow from operations, and this shows us the cash that is generated from a company's products and services. We see Microsoft has increased its cash flow from operations healthily in a year-over-year comparison. This is what you want to see. Now, cash flows from financing includes cash from investors, banks, as well as any cash paid to shareholders in the form of dividends. So also think of stock repurchases, where a company buys more shares of its own stock, and repayments of debt. This is all in this financing section, and for Microsoft, we see it went from negative cash flows to positive. That's good to see, but it does not worry me if this is negative, as a company could always have made a big down payment towards debt, so always look into it. Then we have cash flows from investing, and this is basically any sources and uses of cash from a company's investments. So purchases or sales of assets, loans made to vendors or received from customers, or payments related to mergers or acquisitions. We again see it went from negative cash flows to positive cash flows, and it does not worry me to see negative cash flows here, as they may have done an acquisition or something that could be very beneficial for the company. So always dig into the why. Mainly we want to see that positive and growing cash flows from operations. Now at the bottom, we see the total cash and cash equivalents, and this is positive and growing, a great thing to see. Lastly, regarding the cash flow statement, we want to calculate the free cash flows. You want to remember that. I deem this one of the most important measurements of a company to look at. Now, free cash flow is the money a company has left over after paying its operating expenses and capital expenditures. The more free cash flows a company has, the more it can allocate towards dividends, paying down debt, and growing opportunities. To get free cash flows, you take the cash flows from operating activities and subtract out capital expenditures. Now, capital expenditures are funds used by a company to acquire, upgrade, and maintain physical assets such as property, plants, buildings, technology, or equipment. So for Microsoft, that comes to $20.67 billion in free cash flow. See why I'm not worried about that $25.8 billion in short-term debt? Microsoft can almost pay that off in 1/4 of free cash flows. Now let's look at Microsoft's trend of free cash flow over time. Over the past 8 quarters, we see the free cash flow going up and down, but the important thing here is that it remains above the capital expenditures, and it is doing that. Now, over a longer 8-year annual look, we see free cash flow rising, with the exception of a small decline over the last year, the CapEx declining. This is a great combo to see. Now I look at 3M's cash flow statement. Cash flows from operating activities increased some, cash flow from investing activities went further into the negative, and cash flow from financing improved, but it is still negative. Overall, its cash and cash equivalents did improve this quarter, but with 3M, it has been a different story historically. So this is good to see now, but if you look at the trends, it shows you why I do not like 3M. Quarterly free cash flow trend, we see some volatility with free cash flow, but some improvements over the last 3 quarters. CapEx is also starting to decline. Now, the annual free cash flow trend. Do you see this? They have less free cash flow now than they did 8 years ago. This company is not growing, and this gives me zero confidence as an investor, whereas Microsoft went from about 23 billion to 60 billion over 8 years in free cash flow. That's a big difference. All right, now we have covered the financial statements. We are going to talk about ratios and other financial metrics that I feel are important to review. I created this stock facts label. Does it look familiar? Maybe if you're a regular to my channel, it does, as I use this when analyzing and comparing stocks. It mimics a nutritional facts label that you see on food items in the grocery store, as I wanted to take something that we are all familiar with and make an easy to read format for financial metrics on stocks. So let's look at Microsoft versus 3M. At the top, you have the market cap. This is the total value of all a company's shares of stock. Microsoft is obviously a multi-trillion-dollar company versus 3M's near 60 billion market cap. Then you see the price per share. So right now you can buy 1 share of Microsoft for $367.75, for example. We then move to the price per earnings on a trailing 12-month average percentage. So this is the ratio of a company's share price to the company's earnings per share. A higher ratio means its stock price is high relative to earnings and may be overvalued. That is why I compare it to the 5-year average right below. So Microsoft is more expensive over the last year compared to the last 5 years. 3M has no data as their earnings were negative. So Microsoft is more expensive right now, but maybe that is justified by a new acquisition or product or service that investors feel will add great value in the future, aka artificial intelligence. It really is all up to you to do the research here and see if a low or high valuation is presenting an overvalued, fair valued, or undervalued stock. It is why you want to follow your stocks closely. Sometimes a stock's price falls due to general economic news, but nothing specific about the company. So that may be a good time to buy a quality company. Maybe artificial intelligence is pumping up Microsoft stock price, but you don't think AI has a future. Well, then it probably is not worth buying then. So be sure to understand the PE ratio and its relation to the company, its history, current stance, and future potential. Okay, next is the price per operating cash flow trailing 12 months. This is the stock price compared to its operating cash flow per share. Or you can look at it as the operating cash a company creates compared to its stock price. So for Microsoft, this means investors are willing to pay $29.70 for every dollar of cash flow. Pretty expensive, right? So lower ratios are generally better, meaning it is less expensive, but again, it's all relative and needing more research. 3M over the trailing 12 months had negative cash flow per share metrics that created this NA. So this metric is another way to measure the value of a company, seeing if it's over or undervalued. Then we see the total cash flow growth over the last 5 years, and you can see Microsoft is far superior at 26.53% versus 3M's 3.51% growth. Then we look at revenue data, and we already discussed what revenue is, and I like to compare the trailing 12 months versus the last 5-year average to see if revenue growth is slowing down or speeding up. Again, Microsoft has far superior numbers, and we even see revenue decline with 3M. Next is the gross margin. Gross margin is one of the most important indicators of a company's financial performance. It's the portion of business revenue left over after you subtract direct costs such as labor and raw materials. So it shows how much profit a company makes after paying off its cost of goods sold. So the higher the percentage, the more profitable a company is. We again see the superiority of Microsoft at 76.38% versus 3M's 48.37%. Microsoft is a much more profitable company. Next, we see return on equity for the trailing 12 months. Return on equity is a financial ratio that shows how well a company is managing the capital that shareholders have invested in it. To calculate return on equity, one would divide net income by shareholders' equity. The higher the return on equity, the more efficient a company's management is at generating income and growth from its equity financing. When utilizing return on equity to compare companies, it is important to compare companies within the same industry as with all financial ratios, so keep that in mind. So it is the measure of the profitability of a business in relation to its equity. We see yet again, Microsoft is superior and has a return of equity of 38.32, while 3M has a negative 69.65. This is due to its net loss. They are not generating income from its equity financing. In fact, they are losing capital that shareholders have invested. Not fun to see. Next, we look at debt, simply comparing a company's debt to their total assets and total equity. Debt is something I highly consider when buying a company because high debt limits a company's growth potential as they have to use their cash flows towards paying down debt instead of reinvesting it into the company in many various ways. Microsoft's debt to assets is healthy at a 21.37, and 3M's is actually not bad at 35.09. Now, debt to equity is a different story, where Microsoft is at a 42.55 and 3M is at a massive 158.42, meaning they have more debt than equity. Again, not a good position to be in. Now on to everyone's favorite part, dividends. First up is the dividend yield. Now, a company pays out a certain annualized dividend amount per share you own. So let's say Microsoft pays $3 annually per share you own. So if you own 2 shares of Microsoft, you will get paid $6 each year in the form of a dividend. Dividends usually get paid out quarterly. Some are biannually and some just once a year. But if we take the quarterly example, in that instance, you would take that $3 and divide by 4, and that means Microsoft will pay you 75 cents each quarter to equal the $3 per share dividend it pays out annually. So the dividend yield is simply the dividend per share divided by the share price. Now the share price changes all the time, so the yield will change, and naturally when the share price rises, the yield will get smaller. When the share price lowers, the yield gets larger. So I put together this quick example, and let's say day one, Microsoft stock price is $367. If you buy at $367, you will be getting paid $3 annually, and that equates to a 0.82% yield, the $3 divided by the share price. The next day, the share price falls to $295. You still will get paid $3 per share, but your yield goes up to 1.02%. So in this situation, it would be better to buy on day 2 at the $295 stock price. Look at it this way. Would you rather pay $367 to get $3 in dividends or $295 to get $3? This is the dividend yield example. Now, that $3 never changes unless a company raises it, and good companies increase the dividend they pay yearly as they should be becoming more and more profitable. Companies with bad financials either have low dividend growth, no dividend growth, or suffer a dividend cut. So if Microsoft had poor financials, it may decide to cut its dividend from $3 down to $1.50 per share to save some money. So Microsoft's yield is low compared to 3M's 5.53% yield, but that does not mean you chase that 5.53% yield. This is called a dividend yield trap, because you may buy a share of 3M and have the value of that share decrease as the stock price decreases, far offsetting the benefit of the higher dividend yield. 3M is also the more likely company out of the two to cut its dividend. Now, we can see right here the dividend growth rate of both companies. Now, Microsoft may have a much lower yield, but it grows its dividend over 10% both annually and over the last 5 years, where 3M is growing its dividend at a measly 0.67% over the last year and 1.98% over the last 5. This is a foretelling of the company's financials and shows 3M is struggling with growth and why it does not grow its dividend more. Now the payout ratio. This is the ratio of the total amount of dividends paid out to shareholders relative to the net income of the company. This helps reveal the sustainability of the dividend. A high payout ratio means most of the net income is going towards dividends, whereas a low payout ratio means a small percentage of net income is going towards the payout of the dividend. I like to see a payout ratio below 50% as I want their income going towards other things as well to help grow the company, and it lets me know how affordable the dividend is to the company also. If a company has a payout ratio of, let's say, 95%, it may be at risk of a cut. Now, Microsoft is at a healthy 29.04%, while good old 3M is at a negative 44.91 due to its net loss. Not a good sign. So a healthy payout ratio to me is between 10 to 50%. All right, so this is the Stock Facts label you will see often if you subscribe to my channel and what I deem some of the most important metrics of a company to look for. That was a lot of financial talk and we went over a lot today. I really hope this helped you understand more about reading financial statements and knowing different financial performance metrics, and that it helps you feel confident about investing. It really is not hard. It just takes getting used to looking at the financials of a company or companies over and over and analyzing them to get the hang of it and understand it more. But you will always have this video as a reference to help you with a lot of it. This is something that takes a lot of time and dedication with your investments, so that is why I recommend starting out with maybe ETFs, which are exchange traded funds, and slowly stepping into individual stocks. It's also why I don't think holding more than 15 individual stocks is a good idea, because that is a lot of work. So thank you for joining me on this part 2 of this series talking about financials. Please share what financial item I covered that you really liked. Also share any other important financial items you feel would be beneficial for us on this channel, as this is an investing family and we're all here to help each other grow and become wealthy, and it'd be really great to hear anything else that you think would add benefit. Also, stay tuned for the final video in this series where I will cover the remaining items on my quality checklist. Real quick, as promised, a look at my portfolio performance. I'm transparent, I'm honest, here it is. You'll see Microsoft, a big win for me, 3M, a big loss for me, but let me know if you have any questions. So please share this video with anyone you think would benefit. Let's spread this knowledge, and I hope you have a great rest of your day. See you soon right here on Mark Arnold's Finance.